To become a profitable Forex trader, there are tools you need to use to execute your trade that will make trading easy for you and you trade in a way that it gives you joy. First of the tools is known as TradingView. By the way, today's training that is actually going to be helping you put to practice all the things we have learned together. We've learned the market structure, we've talked about zones, we've talked about confirmation and strategies. So now it's time to put together all those things, how you're going to be able to use it. I'm going to walk you through, find a way to analyze the market on a real time and execute your trade. That's what we're going to cover in this training. So you need brokers, like I mentioned earlier, you need a broker. There are many brokers out there. I do recommend you use the one that is preferable. For me, I prefer using Octa. So if you need the link for the Octa, check the description of this video. You're going to see the link attached to that. Use the link, create your account and log in. So if you're logging in, once you get to this place, you see login. If you look down, if you did not create your account, you see sign up. You sign up. If you're seeing sign up here and you want to log in, you already create an account, switch it to login. Okay, now put your passwords, put your email, put your password, and voila. Once you do that, you are good to go. So you need that as a broker because they'll bridge you, give you access to the market. Now they will enable you to enter the market and execute trade. You need TradingView to analyze the market. The goal of TradingView is to show you where the market is. It shows you what to do. The market is like a thinking room where you come and sit down and think, and your brain process through the thinking room. So the TradingView is assumed to be the where you come to trap the map, look at everything, how the market is, and go through it. Then I'm moving away from that to have the MT5. You need MT5. MT5 is where you execute your trade. So what's the relationship between MT5 and TradingView? You come to TradingView, analyze your trade, see what the market is doing on TradingView. By the time you see what the market is doing on TradingView, you can now, okay, this is what the market is doing right now. Okay, with that in mind, I need to buy or I need to sell based on what the market is doing. Just like you can see, we are in a typical uptrend from here. So like I taught you guys earlier, when the market is uptrend, you buy. So you come here, you see the market structure, you identify key zones, and you wait for confirmation. I will talk about all of those things. So now once you analyze here and be sure you've gotten a confirmation, it's time to execute your trade. You come to MT5 or MT4, depending on the one you prefer, or MetaTrader or Octatrader, depending on the one you prefer. This is Octatrader. You can also come here and execute. Personally, I like to execute my trade from Octatrader. If you notice, most of my alerts that comes from Octatrader, so you can also use here. They're all good. Anyone. So by the way, all that matters is that while you're creating your account, they'll give you access to create your account for whichever tools you want to use. If you want to use Octatrader, fine. If you want to use MT5, fine. If you want to use MT4, fine. But all of these, you will need TradingView. Anyone you choose to use, you will need TradingView. The work of a TradingView is for you to analyze, draw your line, do everything, all the things you want to do all of them. You can do them inside TradingView. It's not as if you cannot do them in other parts, but I prefer doing it here because it gives you more details. And they also have subscription plan that you can subscribe and have more advantage of the tools. That being said, let's jump into the subject of the day. What is the goal of having of today's training? Today's training is to guide you on to have a good setup, a good trading setup. All of the things you've learned is basically the theory. So now we're going to put it down because knowledge without application is a waste of an executive time. So that is it. So if you're coming across this video on YouTube or anywhere you're coming across this video, today's training is actually, this video is dedicated to show you how to analyze the market, execute the trade, put take profit, put stop loss, know how to do this and that. Now when we talk about the setup, for you to have a good setup, there are 4 questions you need to answer in your setup. Now these 4 combinations tells you what to do. The first one is, this place I'm entering the trade, is it a good place? Is it a good place for me to enter this trade at this point? Their place should be able to give you a low risk position. Low risk, your risk should be low for entering the trade at that point. The place you're entering the trade should also give you high reward according to market structure. Yes, it should give you high reward. As if that's not enough, it should also be able to give you a market structured, agreed. The place you enter the trade should be able to agree with the market structure. You get it? So now let's look at how to have a good trade setup. First of all, in case you're new to TradingView, you may not have known how to navigate through it. So I'll take you through it for you to see first. Let's start with that. Go to TradingView. You can see TradingView, trading or trade or track all markets. So once you launch TradingView, this is the interface you will likely see. You likely find yourself around this place. So once you get here, come to this place. Did you see where I'm pointing? These three there's this three hamburger here. So once you click it, will take you now to products. You see products where they write product. So you click product. You see community, other one. Just click product for now. You want to enter the chart. Now you see where they write super chart. So click it. Once you click it, it will take you inside the chart where you can see various charts to analyze. You see it now. So here we are in the chart. You can see it for yourself right now. This is the chart. So here you can navigate through different assets. You can see at this point you can search for any assets you're looking for. Maybe like US 30. Let's do US 30. Yes, you can see US 30, or you can say, let me say GBP USD. You search it there, GBP USD. You can see it's out there, GBP JPY. Anyone that you want to just come and select it. Anything that you are looking for, in as much as there are assets you search here, you can see. So let's just let's look into gold for now. So as I click the gold, it now brings us to this particular place, which enables us to see what gold is doing. So now this is how to find yourself to this place. Why I'm doing this, because a lot of people struggle here. Here you can see your tools. There are tools here. This is where you find your lines. You see this particular place I'm pointing here, you see your lines here. So if you click here, different things will open, different kinds of lines will open for you to use. Now if you tap anyone, let's take like trend line example. Let's assume I want to roll a trend line. So, and this is an example of how a trend line works. You can see. So that is it, all those drawing that you want to do on TradingView. Then this is where you have Fibonacci's. Fibonacci's are here, different types of those ones are all here. Yes, they're here. So we have many other, all the tools are here. Just kindly go through here. You can see different kinds of patterns. That are here. Check through. Then, and also if you want to have where you can get your position forecast patterns, all of them are here. Price ranging, all of them. Then you want to have pencil, or you want to write something, you want to roll something. This is where you can do it right now. You can see it for yourself. Text. This is where text is. You want to write something, you can write whatever you want to write there. Then maybe you need an emoji or icon. This way you have it. I just need to take time and do this so that you not miss it. You want a ruler. There's a ruler here. You can use and measure from year to year how many, whatever it is. You see for yourself. Then if you want to zoom in or out, you can see this is we have it here. So this is zoom out. So believing you've understand what I'm showing you. What I'm actually showing here are the tools, and this is how to TradingView. Then if you here come here, this is where we have indicators. We have indicators. Yes, if you click here, you have different kinds of indicator. If you have a favorite indicator, you can search for them. If you come here, you're going to see candlesticks, different kinds of candlesticks, different types. And here, then time frame. This is where you have time frame. Then if you also come here, this is where you have the replay. Yes, replay is here. So how do you want the replay to start? You want it to start from this particular point, and so we want to assuming we do not know what happened there, so we just want to test the replay at this point. By the way, this is under subscription. Then to add assets or asset that you want, like gold, any other asset you want to trade, this is where to select them or search for them. So I believe I've shown you most of those things. This is price. This is time. Under here is time. Beside here is price. So that's everything I think I need to show you about. There's a lot and every other thing. That's what I need to show you about TradingView. You can now use it now. Knowing how to use it is what you're going to use to draft your execution. Note, the goal of TradingView is to use to analyze the trade. Sit down and analyze, plan the trade, and see what is coming out of it. Then after doing that, you now move over to MT5 to execute your trade, or Octa Trader, depending on which platform you are trading from. If you know you've gotten value, please do well to like so that other people get access to this, and subscribe for more videos that are coming. You come to the market. I've taught you guys this earlier, but let's just do it again for clarity's sake. The first thing you do is you identify market structure. That's the first thing you do. Once you come to the chart, whether it's MT5 or whether it's TradingView or whatever you're using, the first thing is identify the market structure. Let's look at this trend right now. What is the market structure we're having if you are pulling something from here? It's more or less, this a typical, this is like an uptrend. Yes, this is like an uptrend. It's like an uptrend here. So if you can see, this is like an uptrend. That's the first thing you identify. So once you identify this and an uptrend, the next thing is you identify zone. You map out your zone. Okay? You map out your zone. How do you map out your zone? You roll out your support and resistance. Roll out your support and resistance. So at this point, we like to see it well. Let's see what is truly happening inside this market so we can fully understand it. Now, this is how I use. Okay? Now, let's assume something. Let me show you something here. Let's use the previous candle to show something. Let's assume I want to trade this particular candle. Let me talk about this one. This particular candle here. So what I would have need to do is to roll a trend line from here upward. Okay, that's what I would have need to do. Now I would not have seen this upper part of it. There's no way I would have seen that upper part of it. Okay, and also roll this side. So respecting the fact that I will not have been seeing this upper part, that's why I'm rolling it according to this one. According to this, I'm rolling it according to what I see. This is the previous candle. So this becomes the key zone. This is how I would have drawn this. Now remember that while I'm drawing like this, I'm just drawing according to this one and this one because I want to look into this candle. So what I would do in these situations is I would have waited for this candle to pull down to this line. That is when I would have entered the market. Do you know the reason? By waiting it to pull down to this support line, this happens to be my support, this particular line. The line here, let me make it change the color to yellow. Good. The yellow line will become my support, while the blue line will become my resistance. Let me turn it to yes, to become my resistance. So at that point, my stop loss will be below this previous candle. Now I'll wait for this candle to come down here. But unfortunately, it did not come down. I deliberately choose to use this candle to show you example. Unfortunately, it did not come down. I want you to see for yourself that this candle did not come down. So I would have missed this trade because this candle stopped somewhere here. This candle stopped somewhere here and went its way. That was where it stops. It did not, this particular candle, no, this is the candle I'm talking about. I would have expected it to come and reach this support line yet under before I would have buy for it to go up. But unfortunately, it did not come and reach there. It stops halfway and went up. Well, that's normal. It happens. It happens. So I would have waited for the market to still come back to the support. Now, why am I waiting for the market to come back to the support? Is so that it can give me a fair advantage. The risk I'm going to take will not be too much. I want you to have that understanding. The risk I'm going to take won't be too much, because if I enter it at the point that if I should enter it at this point, this candle has the right to pull down to this previous candle. You see where this previous candle is? Let me keep lines, let me mark lines so you can get it. This is where the previous candle stopped. Now this is where the new candle is. So if I should enter it here, now look at the difference between here and here. This candle has right to come down to this point. So I will not have entered it at that point. Rather, what I would do is I would have waited for the candles to come down. Yes, if it does not like to come down, I'll still wait. I'll wait for the next one. So you don't need to chase all the pips in the market. Please let this part be clear to you. You cannot be chasing all the pips in the market, chasing this, chasing that, because if you try like that, it might hurt you. Honestly speaking, it might hurt you. So instead of chasing all the pips, wait for it to give you what you want. So when this one was not able to give, but this other one came and hit the support, when it hit the support, it went. So I would have rather buy on this one. I would have buy on this one and sell and put my take profit at this point. Yes. So you can see now, I'm showing you this. This is on a 4 hour. If you're trading 4 hours, this is the simple strategy, beginners friendly strategy. With this strategy, the take profits you're going to hit is going to be high, and the stop loss you're going to hit is going to be low if you're using this strategy. But the sad thing is that you have less trade to enter. You not enter all the trades. You not have all the trade to enter. While other people are entering all the time, you enter fewer trades. So this is trading 4 hours. This is a simple strategy. You mark your support, your key zone. When you mark your key zone, wait for the market to pull down there. Now, the market has pulled down there. We need a confirmation. To have a confirmation, it is wiser we scroll down to a smaller time frame. It is in a smaller time frame that we're going to see a confirmation. So we'll go to a smaller time frame, maybe like a 15-minute time frame. Go to a 15-minute time frame. We want to see what the market was doing on a 15-minute. Now, on the 15 minutes, there's something happening here. So we could see an hammerhead here. This hammerhead forming at this support level is a confirmation that we should buy. You get it from that angle. That is this particular bearish hammer that is here. It's a confirmation we should buy. And aside from that, we also have bullish engulfing. You see this engulfing, it shows strength that we should buy. So the best place to have purchased would have been here. If you still go down to 5 minutes or 1 minute, you're going to see more confirmations like that. Yes, you're going to be able to see more confirmations in situations like that. So this is how to use it. But I prefer keeping it simple, especially for beginners, that you'll be able to handle it. So let's zoom this place in and see what actually happens here when the market gets to that place. You can see this rejection candle. See this rejection candle here. This market wanted to go down, but it was rejected. Then it pulls up with a bullish candle and pulls again. So by the time this one, notice something here. Let me also show you something. Now notice that this candle, this particular candle here, it has gone above this previous candle, and has also gotten to this other candle. It's giving us a confirmation that the market is going this other way. So it is, and note this happened at a key level. The key level here is this support, is this particular support that we are having here, is the key level. So things like this, when it happens at the key level, it gives you evidence to execute your trade, to take action, to trigger. Okay, so that being said, that's on the happening. Once this thing happens on the key level, it gives you access to enter the market. By the way, we track this thing from a 4 hours, but we pull it down to even 3 minutes to see how it's happening, how it plays out. Because everything that you're seeing on a 4 hours is the same thing that is being displayed. It's being pulled down to give you a smaller time frame. Okay, to the smaller time frame. So how do I use time frame? Someone might be asking that question. Respecting the fact that you're my students and my subscribers as per se, I'm going to explain everything to you. We have the 4 hours. I advise as a newbie trader, start with 4 hours. We have the 4 hours. Now I use the 4 hours time frame to check direction. I use the 15 minutes to check the market's behavior. This is what I'm trying to understand. I'm trying to understand what is that thing that key players are doing in the market. So if you look at this market right now, this is good right now. If you look at this market, we have something happening right now. Tell me, what kind of trade is this? Remember that the first thing you do is to identify market structure. Currently, this is on go. So the market is actually doing something like this, like this, like this. This is what the market is doing. like this. Please, what kind of structure is this? Tell me. I want to hear from you. What kind of structure is this? What kind of structure is the market doing right now? Of course, this consolidating, the market is actually consolidating. It's not going up, it's not going down. So in situations like this, I do not advise newbie traders to trade. I advise you to stay out. There's higher chances of losing money in this kind of structure because the trend is your friend. My mentor used to say that the trend is your friend. Always look out for trend. So the first thing we identify is a market structure, where I try to identify higher high, higher low, higher high, higher low, higher high. But at this point, the market is actually consolidating. It's not an uptrend, it's not a downtrend. So it makes it difficult for new traders to buy because what we are looking for is either an uptrend or a downtrend. And if it is an uptrend, you buy. If it is a downtrend, you simply sell. These are what you're looking for. So if the market is consolidating, I would advise you stay out. But if you know you want to trade this kind of market, you just mark your key level, your support, and your resistance. When the market gets your resistance, you sell. Once the market comes to your support, you buy. Now, you get to your resistance, you sell. But if you notice that, look, the market did not get to resistance at this point. It comes down here, but here it pulls to resistance again. At this point, sell. At the selling, it's not going straight, it's coming down. This is, mind you, this is 4 hours. So this might take like how many? This was on the 1st of, I'm making this video today being 10 of December. Today is 10 of December. Meanwhile, since on the 1st of December, the market has still been at this particular place. Now, on November 25th was when the last time the market hit here. You get it now. So the market is actually consolidating. In situations like this, I do not advise newbie traders to come into the market. I advise you to stay out. Go to the another pairs. There are a lot of pairs out there. We have BTC. Let's check BTC. See what the market is doing on BTC. The market on BTC, here it was selling to this point. Up to this point, is also consolidating. So it's also risky. Check other pairs. There are a lot of pairs. This is the reason I do not advise that you trade only one P, because if you trade only one asset, it might be difficult for you to trade. So here we could see now this one is pulling us on an uptrend. We can say this is an uptrend from what we are seeing here. We can say here this is an uptrend. So if it is an uptrend, what we simply need to do is to mark our key zone. We mark our trend lines. Mark our trend lines. For example, we pick it up from here and go this direction. You can see the key zone, how it's going from here and it's going that direction. So that's our support. We mark our resistance. Our resistance is here. Yes, that becomes our resistance. So that is it. There's no story. That becomes our resistance. So at this point, we simply buy at the support and sell at resistance level. But this is an uptrend from here. The only thing we do is we are going to buy. So we'll wait for the market to pull. Remember what I taught you? You buy at the support level and the markets move to this point. You take your profit and you wait for the market to pull to the support again. Once the market pull back, the next thing you do is you buy again and take your profit. The market will move from here to this point. You take your profit. Once you take your profit at the resistance level, you wait for the market to pull to this support. Once the market hits this support, the next thing you do is that place, you buy again and you take your market and go up. That's how easy, simple it is. Now with this strategy, it will be a little bit easy for you not to easily blow your account. Okay? Not to easily blow your account, because even if the market should refuse to continue, you enter the market at this resistance support level. Where would your stop loss be? Your stop loss is likely to be somewhere around here. Yes, the stop loss is likely to be somewhere around that, let's say that red line, this particular red line. That's where your stop loss is likely going to be. And your take profit is here. If your take profit is there, that's good structure for you to target. Now, believing that part is clear. So the market can choose to refuse to go up and start coming down. If it comes down, you eat you out of the market. It will hit you here. It will not go too much, and whatever you're going to lose is going to be just within Yeah, that's on that note, and I hope that is clear. Exactly what I taught you guys in other training is what I'm explaining here. This is a practical aspect of it, so you can see for yourself that this thing is not just story. So that's on that note. Now the next thing we'll do is now let me also tell you something. You notice this line that this market pulls from year to year. Good. Now we have a fundamental pattern. This structure is called fundamental pattern. I need to talk about this before I'll pass. I think I've not talked about this in many of my training, but it's called fundamental pattern. Okay, good. This pattern that you're seeing here is fundamental pattern. All right, let's leave it at that point. So this first pull here that is going is known as impulsive move or impulsive trend. Anyhow you're going to put it, but make sure you add impulsive. Then this one is known as pullback. This other one that you're seeing here is known as pullback. This one that come down here is known as pullback. So there's important note. And once you get there, you go up again, and in that way it keep going like that. So this impulsive move happens in all the trade. So once you mark your key areas like the way we've done, we'll mark our supports, mark our resistance. The next thing we'll do, we'll mark our resistance. Support is marked and resistance is mapped out. Good. Wait for it at that point. Let the price pull to your support. Once it pulls to your support, you enter. Now I want to also show you another thing. I want to take you down to by the way, this is for swing traders, people that hold their trade for a longer time. Take a closer look at this. Now this pullback, at which point is it going to pull back? Because if we know exactly where this is going to pull back, it will also help us. One, wait for it to come to key area. What if it comes below, or what if not? That's a good question to ask. Once you pulls to that particular place, the market will buy and enter. There's a tool that can help us do that. It's known as the Fibonacci. Fibonacci is a tool that gives us some level of accuracy or percentage of accuracy that we can look at the market. So how do we use it? How can we use it for our best interest? I would love to show you that so you can also know how to use. But note that Fibonacci can only be used in a trending market. If the market is consolidating, you cannot use Fibonacci. So we want to know, where is this market pulling back? We need to know that, where is this market going to pull back or is not going to pull back. So we come to Fibonacci and look for Fib retracement. Now, how do you use Fib retracement? You go to the last swing low and the last swing high. So we want to know where this market is going to pull back. So you mark here. Please note, while you are buying, you mark from down up. You mark from down up. Then while you are selling, you mark from up down. Okay? Good. Now you mark it like that. This is where it is. You can see there's a candle here that week. That was the last swing high on this particular movement. So we mark it there and keep. Now this golden color in between is according to the Fibonacci structure, the golden portion is where most time market like to retrace. Most time. Mind you, this is not 100% accurate. There's nothing in the market that is 100% accurate. The market is always being traded on probability. Okay? So we have the 0.5%. This is 0.5%. And when market approaches 0.5%, which is half of the structure, it will likely reverse. Sometimes it's enter the 0.618 is the best percent. 0.618 is most time the place that the market retrace and continue. So this market as it is here, it might still pull back and enter this place. Someone like me, I will not enter this market. I'll wait for it to pull back and enter this 0.618, and it will give us what we want, and voila, we'll enter the market at that place. Now it is very, very important that this happens on a key area. Please note something here. Note something. I want you to note something. Good. Now we just roll a trend line at this point, picking it from the previous low, which is here and here, where they both touches each other. So we are expecting that this market linear is going to reach to try and enter here. So if it's up, enter here within this key zone, is a clear confirmation for us that we are actually somehow close to being to accuracy. That is it. Now, like I said, I use 4 hours or a bigger time frame to get direction, and I use a smaller time frame to check the market behavior. I decided to show you this for better understanding. Yes, I do that for you to have a better understanding. So I use smaller time frame to check the behaviors of the market, and I use a bigger time frame to check the market structure. Hope it's clear. So now we are here on USD/JPY. USD/JPY is what we are here on. So we have checked the structure. The structure on USD/JPY, if you look at it very closely, you see that we have almost uptrend from what we are seeing here. This seems to be like an uptrend, right? So since it seems to be like an uptrend, anything we are doing is we are going to buy. We are not going to sell. So we'll wait for the market to give us what we want. So the next thing we'll do, we'll pull to a smaller time frame. Let's see the behavior in the market. I'll go to 15 minutes. Good. The previous swing low is this white line, and the previous swing high is here. Now we are looking forward that by the time these candles enter the golden zone, it will retrace. So what do? We pick Fibonacci retracement. Remember that if you're buying, you start from down and go up. Go to the previous swing high and mark it there. Good. I also want to show you something else so you can have a better understanding. There's a fair value gap here. There's a fair value gap. A fair value gap is a line between two candles where candles miss each other. The market will always want to come and clear this fair value gap before it continues. So all of these things are to be put into consideration. You're not using it as if you're a robot. No, you use the market, you trade the market as a human being. As a human being that you are. There's a fair value gap somewhere here. There was a space here in this particular point of which the market missed to clear, which is the difference between this particular candle and this particular candle. So the market will, at some point, while he wants to go up, while considering the golden zone, at the same time, you also want to clear this fair value gap before it will continue. I hope you understand that part. So now the market has actually hit in on the golden zone and it's coming to the fair value gap. Can you see the fair value gap here? It's coming to the fair value gap here. Now, this fair value gap will be the best place to execute the trade. Do you know why? Because we know that the market will definitely want to come in and clear this fair value gap. So if we can execute a trade here, that's fine. But if we cannot, we get it at this golden zone, it's still fine. The only thing that is bringing this market down here is it wants to cover this gap. As soon as it covers this gap, 9 out of 10, it will retrace. Yes, it will go back. So once it covers this fair value gap, it can now continue on its uptrend journey. Well, something can happen. What can happen? It is quite possible that the market might refuse to go. It might choose to start coming down, down, down. So if it keeps coming down, when can we allow it to come and stop? Well, we should be our stop loss is the next question. If we should enter the market here, any of this area within this golden color to this place that the fair value gap is, our stop loss should be this red line, giving your trade a room to breathe. Now look at this last swing low is on this white line, but our stop loss is below the last swing low. Even if we go on 4 hours, you'll be surprised that it will align. Let's go on 4 hours and see it for ourselves so we can have a better understanding of what I'm talking. We are on 4 hours now. So you see the previous candle stops here, the last swing low is here, and even this one. But look at where our stop loss is. So even if this candle should be mad and keep going down and come and pass the previous candle, because note also that this candle has right, this red candle has right to come down to meet the previous candle. There's no offense. It will meet the previous candle. After meeting the previous candle, it now goes back. In short, if you can be patient and wait for it to come down to this previous candle, then it goes back. Once you get to this point, you enter the trade. That will be best. Yes, once you get to this place, you now execute the trade. That will be the best you can ever do for yourself. If you can wait, yes, that is it. So now, but if it gets to this particular place and start going down, start going down, what we know that has happened is a break of structure. It seems there's a change of character. It seems the market is no longer going where it wanted to go again. It seems the market wants to go another direction. So what we do in situations like that is we put our stop loss. If it gets to this place, it should hit our stop loss and remove us from the market. So whatever we are losing we are not losing too much. That is on that note. So let's go back to the 15 minutes so you can see for yourself. So the 15 minutes, once the fair value gap is cleared, it's a possible chance it can go back. So this is how to use it. Then where do you target as your take profit? Your take profit should be, you measure from year to year, and from the point you're entering, you measure it and put there. There's the tools you can also do. You put it there and it will save you the stress. We have the tools known as the trace-based retracement. You pick it from the same point and go to the same point that you stop and pull it down to where you're entering the market. Pull it down to where you're entering the market. Most time I like to use my golden zone, but if I can enter the market below here, I'll be very fine. Pull it down to where you're entering the market and drop it. So this first point, this 1 point is a risk to reward ratio of 1, because from year to year is 1. Then from where you're entering the market to this particular blue line, the whole of this blue line is 2. So we have a risk to reward of 1:2. If you're entering the market from this particular point, if you're entering the market from this golden zone, so where the 1 is our risk, is our take profit. Now we assume that once the market on its own, anytime the market will get up and go, once it gets to this part, it will possibly come down, pull back again and go back. Remember the fundamental pattern we talked about earlier. The market is always moving in a wave, it's not moving on a straight line. So for now, you see that when the market put its neck inside this fair value gap, after it put its neck in this fair value gap, it's like going up. So if you were able to enter the market at this point, you will be on profits as this time we are talking. That is it. So if the market, no matter what you do, this is the neck of the market, you always visit and clear this neck before it continue. Sometimes it might even be funny enough, you might want to clear all the liquidity before it continue, but it will still maintain the trend. 9 out of 10. Fibonacci actually helps you. The Fibonacci, you look at 0.618 and 0.5. That's the golden setup setting. With that, you are good to go. I hope I've explained that part well. So after analyzing this, mind you, all of this we are on TradingView. After analyzing all of this, you've gotten your take profits level. Let me mark it out, horizontal line. This is our take profit level. This is our take profit level. That white line is our take profit level. This is our entry point, and this red is our stop loss. So that have been clear. After that have been clearly analyzed, explained. The next thing we do is we go to our MT5 and click buy or sell. Or if you're not using MT5, you're using Octatrader. Personally, I like using Octatrader. Yes, I like using Octatrader to execute the trade. So the next thing you do is you come to buy or sell. So what are we doing? Are we selling or we are buying? Obviously, we are buying. So you click buy or you click sell and execute the trade. But before we click anything, I want you to take a look at this part this part has a great work to do. It will help you manage your money, because if you do not consider the trade volume you're actually taking, you might be risking too much that at the end of the day you cannot even tell yourself what you're doing. You can't even tell yourself what you're doing. You don't know what is happening. You might think that maybe your village people are against you. Honestly speaking, there's no village people that is against you. It's just you against the chart. So for that reason, you need to know how much you're risking. Like I used to tell my student, I tell everyone this: the market will never take money out of your account without your permission. It is the amount of money that you accept to risk that the market will take. Anything outside of that, the market will not take it. You get it? The market cannot take any money that you did not give permission that the market should take. So before the market will take anything from you, you must have granted permission to the market. That is it. How did you grant permission to the market? You grant permission to the market by your stop loss and your take profit. The amount you're putting while entering the trade is what matters. Yes, that's what matters. How much are you risking? How much do you want to risk in this particular trade? How much are you risking? So all these are questions that you need to answer first of all before executing any trade. You need to know from this point to this point. I'm going to make a video on how to use profit calculator. You at this point, if you enter a trade at this point and put your stop loss at this particular point, how much are you going to lose? How much are you going to lose? If you enter it at this point, put it at this point, how much do you lose? How much profit are you going to make? All of these things are what you stand to understand. Now, once you get here, this is where you can get your lines. You can get your lines here. So if you want to mark trend lines, all of those things are here. Text, if you want to write, check all these tools on your own. Take time and check them one by one. Now, this is where you can have indicators. If you want to use indicators, we have the exponential moving average, we have the simple moving average, we have the relative strength index. Relative strength index is very, very important. What's the work that relative strength index does? It tells you whether these assets have been overbought or oversold. Yes, that's the work that relative strength index does. So it helps you know, should you buy or should you sell. So before you enter a trade, it is very important that you calculate how much you're going to risk and understand that. I'm going to make a video on how to use a profit calculator, but let me show you this. This is the simpler way to do it. So the first thing first you do is you come down to this part. If you're using phone, you click new order or you click buy, it will take you here. So now I'm going to go to new order. And when you go to new order, you have market order, you have pending order. Now pending order is that you want to enter this trade in the future. Okay, not right now. Maybe we said, okay, we say this trade, once this trade gets to this place, execute the trade for me. Yes, we are thinking this trade, once it gets to this particular place, execute the trade for me. That's just the code of new order or pending order. Now, the goal is, we are now saying, pending order, if you get to this particular place now, execute the trade for me. If this trade gets to this place, I want the trade to start. But market order is that we are entering the trade right away. So this is what I want you to pay attention to. Once you come to this place, most importantly, consider your stop loss, how much you're going to lose. I click my stop loss. And my stop loss says, okay, remember our stop loss said we are going to put our stop loss at 156.2, 156.524. That's where our stop loss is going to be. 156.524. 52524. Okay? So if we enter this trade right now, and put our stop loss at this point, how much are we going to risk? We are risking 6% of our account. Now 6% of our account, this is actually a small account of about $20 or thereabouts. I just made it to use it and show you this experiment. Now, that means that if you're risking 6% of our account, that's too much, because you're not expected to risk more than 2% of the account, 1 or 2% of the account. Now, I'm doing this to show you something. I deliberately use this small account because I want to show you something. If you're coming in with a small capital, it will be difficult for you to trade. It is more difficult to trade with a smaller capital than a bigger capital because, one, you'll be violating instruction. One of the instructions is that you should not risk more than 2% of your account. And I'm using a micro loss size 0.01. And 0.01 is telling me that I'm already risking 5 to 6% of my account. That's a violation. At this point, you should be blamed. Now, mind you, you're not putting stop loss according to your pips that you want to risk. No, you're putting stop loss according to market structure. Look, this is the market structure. We are putting the stop loss according to market structure. It's not as we like, but according to market structure. Let that part be clear to you first of all. So if we are putting this stop loss at this point and we are risking 6% of account, it's wrong. So what should we do? You need to increase your capital. your capital is small. The problem here is that your capital is small. So you shouldn't risk that kind of percentage. You increase your capital. So when you come in, you say, oh, can I start with $20? You can start too, but the chances for you to succeed is very slim. And that's why I want everybody who want to trade the market, you have the understanding. Tell yourself what you want to get out of the market first of all, so that you will not be coming here to play with yourself. What exactly do you want to get out of the market? Have you sit down and answer this question to yourself? It's like a person that wants to open a pharmacy, or a person that wants to be a pilot, or a person that wants to fly to the mast. You understand the kind of budget you're going in and the capital you're going in. Imagine someone that wants to that is planning to build a story building, and is starting with $20, $50, or $100. Will it finish? Of course, it will not. That's just the point here. The amount of money that you want to make from trading is not $20. So starting with $20 is your struggling. Forget about all this guru that will tell you, hey, don't worry, come and start with just $10. In short, don't even start with money. Don't worry, all those things are trap. If they have not tell you, let me tell you, it's a trap. It's a very big trap. See, trading is a capital business. So you need capital in order for you to fund your movement. The least I could say, maybe you can just manage and start is $100. Can you start with $20? Yes. Can you start with $20 and succeed? Yes. But the chances is very slim. Very, very slim. Because at this point, look, I've already violated a structure. I'm showing you here so you can see. This is about $19 here right now. Now at this $19, and I'm using a micro lot size of 0.01, and they're telling me that I'm risking too much. I'm risking 6% of account. How much is the 6%? $1.1 or $1.17. And if I'm risking 6%, which is wrong, and I'm aiming to get 2 times this, how much is that? That's about $3 or less than $3 self. Maybe like $2 is what I'm going to get. Why did I get $2? That sounds very small. Now at this point, someone might want to make bigger profits. Yes, someone might want to make bigger profit. So let's go to our stop loss, our take profit. Our take profit is going to be at 157,004. That's our take profit. 1:2 ratio. 157,004. 157,004. 004. That's where our take profit is going to be. Please note, I've not entered this trade yet. I'm actually analyzing it. I'm not making up to $2. I'm not making up to $2. I'm making $1.70 something. Yes, that's the point. So let's assume I'm making $3. It's very small. It's absolutely very small. Yes, it's very, very small. Why am I showing you this? Is because this will help you to have a better understanding of what the market is doing. So what I'm trying to show you here is that this is not what you want. You need something bigger than this. So someone that wants to make a bigger money will be tempted to do something. Please watch what I'm going to do. Will be tempted to increase this. If we increase this, okay, I want to make let me see if I can make like $50 in this trade. So you're now using 0.28. Please look at how much you're risking. You're risking $32 to make 52. That's risky. Yes, that's risky. And you don't even have up to that. You're risking 169% of your account. What if this trade did not go as you planned? What is going to happen? If this trade did not go as you planned, you blow your account. Because you're looking for $50, you've blown your account. So instead of that, all you need to do is, while you're actually reducing your account size or your trade volume, you're reducing your trade volume to maybe 0.01 or whatever you're going to use. Make sure that you're also looking for capital, because capital is the game. Capital is the game. I'm taking time to explain this, and I'm showing you how to calculate this. I'm showing you how to calculate this in an easy way. There's profit calculator. You can also do a similar thing in profit calculator. But this is easier because you have not yet entered this trade. You've noticed, I've not entered this trade. I just come to new order and click it, and it gives me stop loss, give me take profit. If you want to use pending order, you can do the same thing. You can see with your eye how much you're risking and how much you're aiming to get. If the trade is okay, you enter. It's not entering the trade blindly. No, you're not entering a trade blindly, because if you enter the trade at this point, you're entering it blindly without understanding how much you risk. At the end of the day, you lose. So after that have been set or completed, if you want to execute the trade, you place order. Yes, you place order. If you don't want to execute, you close it. That's just the points on that note. Then if you want to do instant order, you come to buy market, and once you go to buy market, but market order, you make sure you confirm the same thing I'm showing you. Put your stop loss and take profit, and confirm how much you're risking before you place yes. Do not jump and place yes or no. This part should be very, very understood. I'm taking time to explain this. So with this, if you click sell, it will sell. If you click buy, it will buy. If you complete the order now, it will move. I'm taking time to explain this volume, because this part is very, very important. This is what controls your profits or your losses. The volume of losses you're going to have. The reason that people are blowing the account every day is as a result of this. And I believe that I've been able to explain this in a way you can understand. So once you're done with that, you see you're okay, you click open order. Once you click open order, the market will open right away. Yes, that's just the point. Once you click open order, the market will open. Let me do it for your present. Let's assume that, okay, I'm settled with everything. I just click open order. You can see the market has opened a new order for me at this point. You can see it here. I'm only doing this as samples for you to understand. But let me also show you something at this point. Did you notice that the market was at this point, but when I open the order, it opens at this point? Who can tell me what is happening? Please tell me in the comment section. Tell us in the comment section what exactly happened there. Of course, that's spread. Spread is what happened. This is where the actual market is, but this is where they will start to count for me. So by the time this market pulls up to this place, they will start counting it for me as profit. But as long as it's here, they have charged me spread for allowing me to enter the market. I have to take time and explain this step by step for you, because I want you to have a better understanding. So that's how far we can go. I hope it's clear. You can do the same thing on MT5. I use TradingView to analyze. You go to your tools on MT5 and execute your trade, or go to OctaTrader. Like I use OctaTrader here. Now there are other assets, like you can see this GBP USD, there's NAS 100, US 30, and so on. You can go through all of them and check the one you want to trade, the one that is okay for you. Check all of them, and you can trade any one of this one. Any of this one you can trade and use it for yourself. Hope you got value from this video. If you do, please kindly like, share, and comment. Okay, if you have any question, please drop it in the comment section. I'll always be there to see as much as I can help you have a better understanding. The goal of this training was very simple. The goal of this training was to help you be able to have a good working strategy. Please, let me let you understand this, that there's no strategy you're going to get overnight. All of you are going to master all of these things is going to be by repetition. So, for all what I've done so far, what is it? If you know you've gotten value, please like this video so that other people have access to it. What have I done so far? Let me explain it once again. The first thing I've done is identify the direction. That was the first thing I did. Identify the direction. So it's an uptrend. So after identifying the direction, the second thing I have to do is mark key zone, mark area, support and resistance. After marking the support and resistance, that's the key area, mark the key zone. Okay, now the next thing is you might wait for a breakout or retest on the zone. When it pulls back, you don't rush and enter it. Wait for him to test this particular zone. Once it tests this place and it's about going up again, that is when to buy. So when it's about going up, the next thing you need to do is wait for confirmation. Wait for confirmation. What kind of confirmation can you get? You can get something like a pin bar, like this. A pin bar like this particular candle you're seeing here, or a bullish engulfing, or an inside bar. Yes, pin bar is basically what I do recommend. For example, like this. You see, like this place, this is at the support zone. This white line is the support zone, and this small candle that you see here, you notice this small green candle? When the small green candle pop up at this support zone, is a confirmation that the market is about to go this other way. So we can buy. So wait for a confirmation like that to happen. Once the confirmation happens, you enter the market, and voila, you are good to go. Like I said, it's optional. If you want to use indicators, we have the RSI, Relative Strength Index. It tells you the level that the market is, whether the market is overbought, is about to be sold. Like the case of this particular one, what it's telling us on GBP JPY at this point is almost overbought. You see where it is. It's almost overbought. It's out of the range. So at this point, you look for a selling opportunity. That's what it's telling us. So once that has been done, you execute your trade. But please note that use these things with confirmation, and there's no strategy that is 100%. 100% strategy does not exist. Okay? Now with that, you can mark your stop loss and your take profit. Enter every trade with your stop loss and take profit, just like I've shown you. Make sure your stop loss and your take profit is always there. Now you enter after a confirmation. Yes, that's when you execute a trade. For example, this was an indecision. But here, this candle pulls up. When this candle closes, it's the right time for you to enter. There's a high chances it might go up. Or most cases, I like to see what they will do if there will be a pullback. That's on that note. Like I said, there's no 100% assurance. Put your stop loss below here, below the previous candle. This way your stop loss should be, and your take profit at the next resistance level. Then make sure that you're risking 1 to 2% of your account. Don't risk more than that. No matter what is going to happen, no matter what, don't risk more than that. If it is more than that, either you add money to the account or you leave the trade, reduce your trade size at that point. That's what the point. Never you enter a trade without a confirmation. Never you forget to use your stop loss. Yes, very, very important. And avoid over trading, especially during news events. I'll talk about that on the 11th. Avoid over trading, especially during news events. Hope you got value from this video. Whatever you want to learn, please drop it in the comment sections. I'll look into it and I'll also make a dedicated video on that. Thank you very kindly for watching this video up to this point. I hope you've got value. Let me let you understand this, that the market does not listen very well. The market does not know you. It does not know that you're in the market. The market does not hate you. The market is only paying consistency. And the only way you can become better is doing it every day. It does not pay people that are guessing. It pays people that understand what they're doing. I'll personally advise you to know your onions. Take time and learn trading very well. Repeat this thing every day. Let it become part of your life, that you're practicing this every day until you get mastery over it. Do not just try it 1 time or 2 times and say it did not work, it's not correct. No. Practice it all the time until you get it right. Thank you very kindly for watching this video. Like, share and comment, and see you in the next video. Bye bye for now.